Yo, what's good, Pippin Day family? Ollie Trades here, and in this video, I'm going to be showing you the ultimate smart money concepts guide. I'm going to be breaking down breaks of structure, fair value gaps, liquidity sweeps, order blocks, and at the end of all that, I'm going to be giving you a strategy that uses all of these that's so simple that you could start using it to make money today. And if you don't know what any of those words mean, don't worry, because I'm going from a beginner level all the way to an advanced level, and let's get right into this. So to start off, I want to get into breaks of structure. And breaks of structure, by definition, are going to be when the market has shown us a clear shift in its trend, right? So you guys are going to understand, obviously we have bullish markets, which end up looking like this, where price is overall creating low, high, higher low, higher high, higher low, higher high, right? That's very simple to see. Now that is a bullish structure. Now, once we would get out of this bullish structure is the moment you can identify that now instead of creating higher lows, we're creating lower lows, right? So once price were to break under this level here, that would be considered our break of structure. So you guys could see where this yellow line is would be that break of structure, where price was now, instead of moving bullishly, signaling to us that it's going to move bearish. Now on the opposite side, right, if we were in a downtrending market or a bearish market, price is going to be creating lower lows and lower highs. And the second that price has now pushed itself into a higher high, that's going to be where we identify our break of structure. And this is going to be probably the most important part, is how well you can identify these breaks of structures, because people do get confused and lost in the middle of it. And then you would see price pull back and essentially start shifting its structure. Right. Now it doesn't stop there. On top of breaks of structure, we also have continuations of structure. So that's where price is already moving in that direction after the break and is now just continuing, right? So we're not looking to go from bullish to bearish. It would be going from bullish to bullish or bearish to bearish. And so I wrote the definition for that right here so you guys could write that down. But it's basically going to be when market has shown us a continuation in its same bias. And as you guys can see, that would be when bullish has now continued and showed us that it's created a higher high, or when bearish has now continued and shown us that it's created a lower low, right? So very simple, but also you don't want to mix those up, because when you are actually marking things out, it's important to have it as clean as possible. And I want to show you guys a couple charting examples and a couple what ifs, just to make sure that you do these as precise as possible. Now, I'm going to just do this on the 1 hour time frame and show you guys an example of a break of structure, right? So let's bring charts back to this level here. Here you guys can see price was obviously trending upwards, right? And then shifted its way towards the downtrending market. And you guys can see we'll create a little pullback. Price continues its structure down, pullback continues its structure down. And from this moment on, in order for us to break structure, because this was the previous high that we had, this is where we would have to see that structure get broken, right? So I'm going to make this red. If it's a break of structure from now on, it's going to be red. If it's a continuation, it's going to be light blue. So one common misconception that traders have, and I don't know exactly if the setup will have it, is that they'll count a wick above this structure as a break of structure. But we don't see a break of structure until we have a candle close. Now, this is very important. It's going to go across a lot of time frames, but whichever time frame that you are basing your main breaks of structure on, you have to see a candle closure above the highest wick over here. So if this was my high, it's because the price had wicked all the way to this level. Now I need to see price close above that. So as I play this out, you guys can see price has now closed above this level and given me a break of structure. Now from this moment on, once we get one pullback candle, I'm now looking to see how deep this is going to fall to then identify my new low, right? So price is pulling around here. And now this isn't my new high. My new high is going to be this level here, but I didn't have a break because there was no candle closure. So in terms of this being a continuation of structure, people would have thought, okay, it had to continue over this level here, right? But the common misconception is that people get confused and will count the wick as a continuation of structure, even though it's not. So here you guys need to see, okay, it just pushed my high higher, but it didn't break that structure. So now I need to see price break above this level to now consider that to be a continuation of structure. So as I let this play out, you guys can see price has still only wicked above. So it wicked above to here and it wicked above to here. So far, I'm not counting any of those as a continuation of structure yet. And then I'm just going to let this play out. And finally, at this level here, we get that continuation of structure, because you guys can see the candle did not push my high higher, it closed above it. So now my low will be this level here. And it's very important to be able to identify those lows and highs, because that's what's going to separate you from a bang average trader and an advanced trader in identifying real market structure. Is, can you identify when highs and lows are pushed versus broken? to then make sure that you're on the right side of the market and following the right side of the trend. And I'm going to let this play out and just simply follow through. So here you guys can see we would have another continuation of structure at this level here. And since this is our continuation of structure, I'm going to look at the lowest point where price was at in that area. And now in order for me to see a break, I have to see price break under this level. Or if I want to see a new continuation, it has to be a candle closure above this level over here. So as I let this play out, you guys can see my low has been pushed lower, but it wasn't broken. So I don't have a break of structure towards the downside. And I'm just simply following along here. And then overall price continues towards the upside again, giving us another high. Very, very clear understanding of breaks of structure versus continuation of structure. And this is showing us a very heavy bullish trend. And so now just to show you guys a bearish example, you guys can see very clearly price was pushing up here. And in order for me to break my structure, because nothing here closed above that, I still need to see a close under this level here. And that would be where my break of structure would be, right? Because as you guys follow along on the hour, you can see we had this over here, a pullback candle, and then just highs being pushed even higher. So it's either going to be a break of structure on the lower side or a continuation of structure on the higher side over here. And I'm just going to let that play out. You guys can see overall price pushes my low. So still no break of structure at this level, still no break of structure here because my low is being wicked, which means it's being pushed lower. And then at this level here, upon this candle, we finally have a break of structure, right? So in order for me to continue my structure, as you guys can see, this is where that initial break happened and price pulled back one candle, meaning that if I were to continue my structure, all I have to do is see the price give me that bearish candle printed under it again, like it did there. So at this level here, we'd have a continuation, and you guys can see price pulls back up over here, then continues our structure further lower upon this candle here, because if I zoom in over here, you guys can see price does not break under that, or maybe it does a little bit, which would make it then, or if it's just equal with that wick, then this would be the level where we continue our structure. And so now we're going into order blocks, which are going to be areas of supply and demand found at the lows and highs of breaks of structure that are used by banks to place their order. Now guys, order blocks have changed my trading game. I used to be a very heavy support and resistance Fibonacci trader, but once I discovered order blocks, this really pieced everything together for me. I want to show you guys first how to identify an order block. So remember, we had breaks of structure, right? So if markets were shifting bearish, and then now they've shown me a break of structure towards the upside, which would be identified at this level here, and we're going to make that red because that is a break. Now you're going to identify the lowest candlestick over here, and that area right there is going to be your order block. So it doesn't matter which time frame. There's a 4-hour order block, a 1-hour order block, a minute 15, and you can always refine those on down, but it's going to be that lowest candle. And once price continues its structure, it's going to be the same thing, and it's going to be an order block resting at the low after that continuation level. So once price has now continued onto this area over here, you would then again find your lowest candlestick over here on whichever time frame you're on, and that would now be your new order block. And these are going to be levels that institutions, like I said, are going to be looking to place their orders off of. So there's going to be a lot of movement in these areas and the highest probability that you win your trade. And now just to show you guys how it would look if I were moving from bullish to bearish, price would essentially be creating higher highs and higher lows, then shifting on its way downwards, continuing further lower, and my order block would be that highest candle over here. You would see price pull back up into that level and then continued structure, which would then leave you with a new order block there. So just to clearly state this over here, this would be the break of structure level, and then this would be our continuation of structure level right there. And now when it comes to order blocks, I have a very simple rule. That's going to be that for a bullish order block, if you have a bullish candle OB, you're going to mark it up from wick to wick. And if you have a bearish candle OB, you're going to mark it up from body to wick. Meaning that if right now price was moving like this and then broke structure towards the upside, and now I'm looking to mark up my order block down here, meaning that if this candlestick were bullish, knowing that I'm on a bullish order block, right, because price just broke towards the upside, I would mark this up from wick to wick. So my entry level would be at the top and my stop loss would be at the bottom, right? And now if this were going to be a bearish candle, right, so the opposite side of the order, a bearish candle at the bottom on a bullish order block, my order would just be from the body to the wick low. You always want to make sure that you cover the wick low, because there's an opportunity that if you don't, price could come all the way down here, give you an equal low, and then go back up, and you would have just got stopped out because you played body to body, even though your analysis was correct. And it's going to be the same thing on bearish order blocks, right? So bearish order blocks, if you have a bearish OB candle, it's going to be wick to wick. And if you have a bullish OB candle, it's going to be body to wick high. So let me just show you guys how that looks. Here, we would have an uptrending market where price would now break structure and then come back in. And now we're identifying that order block. So if I have a bullish candle, right, it's going to be the body to the wick high. This would be my entry down here. This would be my stop loss. And if I have a bearish candle, it's going to be wick to wick. So let me show you guys some charting examples so you guys can really piece this together. As you guys can see over here, Euro USD, right? And we were trending towards the downside, but eventually we have this over here. Then our low gets pushed lower, meaning that if I'm going to continue my structure towards the downside, I have to break over here, or I have to break above this level here to see a break of structure, which you guys can see happens right there. Now my lowest candle over here is going to be a bullish candle, meaning that I'm going to mark it up from wick to wick and just watch what happens when price retraces into there, right? Price was moving bearish, 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 wicks all the way down here on this day, and then pushes all the way back up and allows you to see a very good risk to reward ratio just off identifying a simple break of structure on the daily time frame. And this works across all time frames: daily, 4 hour, 1 hour, minute 15, minute 5, minute 1. But it's about being able to combine all of them. And obviously the higher time frame, the better. So make sure that you're always using a top-down analysis. And you guys can see price didn't even stop there. It continued to run all the way up. And that could have been a 1 to 8.6 risk to reward ratio just by identifying one break of structure and allowing markets to reach that level and play in your favor. And guys, it's very important that when you actually are identifying breaks of structure, that you don't get patient and see price come all the way and almost tap you in and then want to take an impulse entry. So for example, you guys can see over here, right? Price obviously broke structure right when we reached past this level here. And then we mark up this order block, and it's a bearish order block on a bearish order, right? So I'm going to go from wick to wick. Now I mark this out, I draw this all the way right, and I'm going to let this play out just so you guys can understand, right? Markets obviously tank very far and then come all the way back up and look like they're about to tap us in and then start to move further lower. Now, yes, obviously there's going to be moves across the way, especially on the lower time frame, but I want you guys to understand the significance of these order blocks that are really resting at high levels here, right? So you can see that this is the highest area that we had been at since April 2022. So this is April 2022. This would be July 2023. So that's a significant high, which means that there's going to be a lot of values held at that order. Now you guys can see once price actually pulls back up, it still almost taps you in over here, but then eventually taps you in at this level and is able to run down and give you some huge profits just off of literally identifying one break of structure. And yes, this really is the type of thing that you could just identify these on the daily across every single pair and set your limits across that, and it would be a profitable strategy. Although that does take a lot more time, and a lot of people don't have patience for that, so they tend to go to the hour 1, minute 15. But for an educational purpose, I just want to show you guys how strong the daily time frame actually is on these. And you guys can see that pretty much runs all the way down, clears out the lows where it fell from, which would be my target, right? So I would always want to take something to the lows that we just fell from, but it even, sets up all the way until we had that buy order, which I just previously showed you that. And now we're going to hop into the final piece, which is going to be fair value gaps and liquidity grabs. Fair value gaps, by definition, as you guys can see here, are areas of imbalance in the market, which are later to be filled in to stabilize order flow. And a liquidity grab is markets wiping out areas with lots of money resting there to then move in the opposite direction. Let's start off with the fair value gaps. Imagine you have 3 candles, right? Obviously, every single candle is going to have its own wicks, its bodies, and it's going to move in a certain direction. And so one thing you're going to notice in normal price action is that if you follow a simple 1, 2, 3 pattern, you're going to see the wick of 1 is going to touch the wick of 2. And this right here is going to be noticed as balanced order flow. Now, oftentimes what we're going to see, especially after breaks of structures at levels above our order blocks, is we're going to have imbalances in the market. Now, what do I mean? It's going to be the wick from level 1 and the wick from candle 3 aren't going to touch. And what that leaves us with is a fair value gap or an imbalance. Now I'm going to mark these up as green so you guys can understand that. And these are going to be levels that they don't necessarily have to get filled into now, but they are great as using as an extra set of confirmation when you're looking to see if your order block is valid, right? Because we understand that markets do have to stabilize, but the key is to understand that markets do not have to stabilize now. It could happen later, and that's where most traders get confused. So make sure you guys write that down, right? Because markets could essentially do this, come back, and then finally come back to fill it. So don't get confused in thinking that it has to happen now. Like I said, it does not have to happen now. Markets do not have to happen now. And at the end of the day, the markets can completely disrespect every single rule as they see fit. And that's oftentimes because of a high impact news release or something. And now just so you guys can understand liquidity grabs, right? Imagine that price was trending bullishly here. And a lot of the times markets are going to consolidate and start building money across both sides. And then you guys are going to see something like this where we now have swept the lows over here. And this is going to convince people that we're now moving into a bearish market. A lot of breakout traders are going to be getting into that. And then what's going to happen is actually market just pulled all the money resting over here to then get into a better position for its order and then sweep all the money resting at the highs over there and give us a higher high. So a lot of times when it comes to order blocks, you're going to see you obviously have previous structure, right? So something like this, where you now have a break of structure, price pulls back in, gives you your order block, and then you guys see a continuation of structure here. This would be the new order block level over here, and money would be building up along this level, and somewhere along here you would most likely see a fair value gap, right? So that's kind of how you would piece all of those things together, and let's actually show you how this looks on the chart. And so here you guys can see Euro USD on the hour forward time frame. Now, if I mark up my order block, obviously it's a bearish candle on a bullish order, so I'm going to mark that out right there. Okay, up next, I want to identify, do I have any liquidity resting across here? Well, I can see all of these wicks touching over here, this big consolidation phase, which is showing me that most likely I'm going to see a lot of money getting swept from this area. And now if I follow the 3 candlestick sequence, where I have 1, 2, and 3, and this second candlestick is not covered by the wicks over here. So I can draw a fair value gap over here. So now if I look at this, okay, obviously I have my order block resting at the bottom. I have a fair value gap resting over here that needs to be filled in. It doesn't have to happen now, but it needs to later. And I have liquidity resting at this level. So if you think of price like a magnet, right? Price, what it wants to do, if I'm looking at this sequence here, is sweep out the money resting over here, because when these banks want to trade, they don't want to share their piece with everyone else. They want to take the biggest position they can and get in at the best price. And think about it. If you're going to buy something, you don't want to buy something at $10 and sell it at 20. You want to buy it at $5 and sell it at 20, and you want to maximize your profits. So we have liquidity resting over here, which would want to be swept. That's where my brain would look at. And then I would have a fair value gap over here, which price would want to fill into to stabilize the market. And then I have my order block down here, which would be the level that the banks would want to get in at. So now if I set my limit over here and I were to just target the high over there, I have already a almost 1-to-8 risk to reward ratio, and I would just let price do its thing. And you guys can see market actually gaps, and instead of gapping and running all the way through, there's a reason why it gaps, holds this order block level, and then pushes back up. And as you guys can see, price pushing back up, making its way further higher, and then eventually it hits our take profit level. And so just to give you guys one last example, here is GBP JPY. Now, right off the bat, I can see this would be my order block over here, right? Let's just make this level white just so we don't mix up the color coordination of the video. Now, this is obviously because we had this big break of structure up over here. I mean, it's very clear. I'm not even really following anything, but this is a very clear high point that you guys can see we broke above there. In reality, the break of structure that creates this order block would be resting at this level over here. Now, I don't necessarily want to take a huge order like this. So I started going down on my time frames, and you guys can see the minute 15 order block over here actually looks very clean, right? So I'm actually able to refine to this level here and then start looking for those little things that we talked about, right? So do we have liquidity built up? Well, we have a lot of liquidity resting over here. You can see all these wicks over here. And we also have liquidity resting kind of at this level over here, where you can see price makes this sudden drop and then makes its push on upwards. So another thing that we would want to identify is, do we have a fair value gap? So if I actually look over here, I do have a fair value gap resting right at this level over here. And the reason why this technically isn't a filled fair value gap is because we didn't fill it in 50% of the way. Had this level been filled in 50% of the way, and you can easily check this by just drawing any Fibonacci tool and seeing where your 50% mark is. So if this had filled in 50%, then I would have considered this fair value gap filled, but it didn't. So I still consider this to be a valid level. And so now I'm looking over here. I have a very clean order block on the minute 15, bearish candle on a bullish order. I marked that up right. I have my breaker structure at this level. I have liquidity that still needs to be swept later on. And I have a fair value gap resting over here. Considering that my fair value gap is resting within my order block, and now I can go on to another lower time frame and still try to find a more refined entry, right? So if I look at the minute 5, I can now mark up this minute 5 order block just to refine that minute 15 down more. And then as you guys can see, if I were to set my limits on the minute 5 order block, it would look like this. And then I would just be targeting the highs, which we previously fell from, which is over here, for a 1 to 7.38 risk to reward ratio. And if I just let this play out, you guys can see, I mean, price literally wasted no time after it touched our entry, and then literally sprints not only to our take profit, but past it. And the reason why I don't target areas past our take profit level is because I believe that I just want to catch the level that creates the higher high, because the whole premises behind this is to find a level where price is broken and then to reach the continuation of structure level. It's not to try to predict how far it's going to go to squeeze all your profits, because in the end, you just end up losing a lot of money that way. And so just to wrap this up, I want to show you guys a very clear checklist so you guys can write this down and make sure you follow it. And it would be identify your break of structure, right? So if price were to be moving downwards, right? Once you have that break of structure, you then want to go in and mark up your order block. Once you've marked up your order block, you want to identify, do you have a fair value gap? Okay, maybe you have a fair value gap in this level over here, right? And if you have that fair value gap, identify where your liquidity is. So maybe, you know, on the way up, price actually chopped up over here a lot and left a lot of liquidity. And then obviously, if your fair value gap is very deep into your order block, then that is going to be your sign to then go on and refine your order block to a lower time frame. And then set your limits, watch as price makes its way back down and then pushes a new high. And when you actually take these trades, guys, I cannot stress enough, do not try to predict how far it's going to go. Just take it to that continuation level. Now, guys, this is the strategy that has really set me up in trading. It's done the most for me. And I promise you, if you follow these rules, it will work. It is a profitable strategy over a long period of time. By now, you should be pretty confident in smart money concepts. And if you guys want to start trading this strategy today, make sure to click the broker in my description. This is the best broker, best executions, best spreads, and even a 250% deposit bonus, so you guys can have a bigger account and even capture bigger profits with that without necessarily having to risk your own capital. I appreciate every single one of you guys for watching. Make sure to like, comment, and subscribe, and let me know in the comments what you guys want to see next so I can make a video on that. See you in the next one, Pip and Dip family.